Hello and welcome to the Global View on this Tuesday. I'm Andrew Gagan. Good to have you with us again here at AusBiz. Let's take a look at what's going on globally. Equity markets reeling from tariffs announced by President Donald Trump, with investors seeking to de-risk their portfolios on the prospect of a global trade war. Wall Street's main indices did recover slightly towards or just after the close, in fact, as Mexico struck a deal to delay new tariffs for a month, while Treasury yields declined as investors sought safety in US government debt, and the CBOE volatility index climbed sharply. Shares of US chip makers came under early pressure, with Nvidia, Broadcom, Marvell and Qualcomm on the move, along with Advanced Micro Devices and Intel. The car makers were also pressured. That include Tesla and Rivian, along with Stellantis and Volkswagen, which have major operations in Mexico. Whereas the gold miners gained as bullion prices rose to another record on safe haven demand. Meanwhile, on the earnings front, meatpacker Tyson Foods raised its annual sales forecast as strong demand for beef and chicken helped it exceed first quarter result estimates. Well, President Trump has paused new tariffs on Mexico for 1 month after it agreed to reinforce its northern border with 10,000 National Guard members to stem the flow of illegal drugs. Donald Trump saying, "I look forward to participating in those negotiations with President Sheinbaum as we attempt to achieve a deal between our two countries." And a short time ago, President Trump said he'll postpone threatened tariffs on Canadian imports for at least 30 days, according to Prime Minister Justin Trudeau in a post on X, who said he'd had a good call with the US President. And US President also suggesting that the European Union would be his next target, saying they don't take our cars, they don't take our farm products, they take almost nothing. We take everything from them. EU leaders have said they would respond in kind, but also called for reason and negotiation. And President Trump has signed an executive order for the creation of a sovereign wealth fund within the next year, saying it could potentially buy TikTok. Now, Federal Reserve member Raphael Bostic has said the central bank's tariff response will depend on inflation expectations, while fellow member Susan Collins has said the Fed is unlikely to react to tariff-driven price increases, saying if expectations remain well anchored, the Fed would try to look through those. US Treasury yields did fall as investors sought US debt on inflationary concerns. The 2-year Treasury slipped to about 4.22, the yield on the 10-year down about 6 basis points to 4.5%. And the US dollar unwound most of the previous day's gains, with the Mexican peso turning positive from a near 3-year low as President Trump announced that 1-month reprieve. The Aussie trading at 62.3 US cents, so it has just bounced higher, particularly off the back of that news of that reprieve for both Canada and Mexico. And Bitcoin also staging something of a comeback too, to trade close to 102,000 US dollars. On the commodity front, oil prices edging higher in volatile trade. Brent futures up almost 0.5% at $73 a barrel. Copper is off more than 0.5%. Iron ore around 1.2% lower at $104 US dollars a tonne. And gold has hit another record high, bolstered by safe haven inflows. US gold futures were about 0.8% higher at $2,857 an ounce. Let's get across all those movements on the markets, the response to what we're hearing from Donald Trump. Steve Sosnick joining us from Interactive Brokers. Steve, very good to catch up with you again. This, as we well know, with the Trump presidency, we've got to react pretty swiftly. It all moves very quickly. What did you make of that most recent news then, a reprieve for both Mexico and Canada? What's the market response been?
Well, good to see you, Andrew. Hope you had a good, hope you have a good morning to you. Basically, the market freaked out at the tariffs. We started to sink a bit Friday afternoon when it became apparent that tariffs might come into play. And then we sank, we sank aggressively overnight when it appeared that there would be 25% tariffs on Canada and Mexico, and then another 10% on China. But then, of course, the markets reacted very well when the president apparently had a good phone call with President Sheinbaum of Mexico, and we're hearing good conversation occurred with Prime Minister Trudeau of Canada. So it's very much a moving target. It's hard to tell how much of this is a negotiating ploy, how much of this is for real. What it does tell us is that it's hard to get complacent with anything right now because these are very much moving targets. From a U.S. consumer point of view, the tariff delay with Mexico was well timed because we have the Super Bowl this coming weekend, and we eat a lot of guacamole and drink a lot of Corona beer. So that probably is pretty helpful. You don't have to go panic buying your avocados now or your Corona. But getting more serious, this there's still a lot of moving parts, and 1 month reprieve is not a full reprieve. Um, and it's a little difficult to know what the end game is because remember that during the first Trump administration, he renegotiated what was the North American Free Trade Agreement, NAFTA, and replaced it with the USMCA, which was sort of a new, improved NAFTA. And it's understandable why a treaty might need to be updated. But I can't see things having changed that much in 4 years from a treaty that the president himself negotiated. So there's a lot going on here. It's tough to know what the end game is. It's also tough to know, it's one thing to have targeted tariffs. It's another thing to have blanket tariffs. There's a lot of things going on here, and it's very tough to know how this ends. I guess the good news is, it's forestalled for a month. And also perhaps it means that, if we were able to negotiate a bit, that the tariffs can be turned into something more targeted rather than something just a blanket tariff across the board.
It has, I mean, regardless of the outcome, it's undermined confidence, hasn't it, Steve? So, leading perhaps to an impact on investment, purchasing, hiring, given on that uncertainty.
Well, that's the thing. I mean, markets, I think there was a bout of confidence after the inauguration when it appeared that, people were getting excited about the idea of lighter regulation and a more business-friendly climate. But now I think there is sort of that question of what can we really rely on here? It's tough to plan when you don't know what you're planning for. I think that, over his career, Donald Trump has sort of embraced uncertainty and a certain amount of, I don't want to say chaos, but a certain amount of, unpredictability. I think he sees that as an asset. From a business point of view, it's tough to plan. You don't really know what you're planning for. And companies, particularly those with long lead times, like a little bit of certainty. Then there's just some out of the blue stuff, the sovereign wealth fund. Um, the US doesn't, most of the countries that have sovereign wealth funds basically do it as a way to invest their surplus savings. A country that does a lot of exporting. Let's say your Middle Eastern countries, which export lots of oil, or Norway or Singapore, which have huge trade surpluses and saving surpluses. That's a way to invest them. The US, our problem is deficits, not excess savings. So there's also the question of, is he doing this just to benefit, his friends who frankly, one of the owners of ByteDance donated, over $90 million to his campaign. So, is this to mollify them or is this a serious ploy? There's also the questions of what's going on with Elon Musk vis-a-vis and his team that has sort of been just running roughshod over certain parts of the federal government. It's all a very uncertain climate right now. And so this is really what we have to deal with at this point, and it's very tough to know what to expect. And I think while confidence generally in markets and the economy remains high, I don't think it was any sort of surprise that when things started to calm down today, we didn't really see VIX come all the way back to the levels that prevailed beforehand. I think people are realizing that it's fair to expect a bit more volatility over the coming days and weeks.
But is there that temptation to buy the dip? And I guess this also comes after that turmoil we'll see in markets last week in the wake of DeepSeek.
Yeah, well, you know what? This is the crazy part. I mean, the DeepSeek story. It was literally a week ago that you and I were talking about DeepSeek and the disruption that brought. And so, this is there's so much going on. The DeepSeek, of course, was sort of a different sort of exogenous factor. But this is telling us that we can't be too complacent. And it's interesting because tech has actually started to underperform the broader market, um, which is a bit of which is a bit of a change from what we've seen in recent weeks. And so, again, there's, I think anytime, we're still seeing customers trying to buy dips. We still see dip buyers in the marketplace. That's pretty much normal. And quite frankly, again, it's a strategy that's worked rather well for the better part of certainly the last 2 years. And, over a 5-year period, with the exception of 2022, it's generally worked well then too. And so people feel emboldened to do it, and I don't think there's anything wrong with it. People have been buying dips for as long as there have been markets. But I do think it behooves people to wonder a little bit maybe whether if you're going to go long, maybe it requires a little more caution, maybe it requires a bit more risk management, or maybe it requires a bit more hedging.
And just briefly, Steve, lost in the wash is the latest economic data. I see that the ISM manufacturing PMI turning back into expansion essentially after a couple of years. What does that say, particularly as far as the Fed is concerned?
Well, it's telling us the economy is doing okay. And again, I think people lose sight of the fact that we're probably, the markets actually really do, although we love rate cuts, although we all seem addicted to the liquidity, we do better with a stronger economy. Again, this time last year, we were looking at 7 or 8 rate cuts. We didn't get them, but the markets did fine by not getting rate cuts because the economy was good. And so I think that, the bond market, of course, has to care much more about the path of rates. We saw the curve flatten a bit today, but basically, this is literally the goal of the tariffs, right? Is to improve the manufacturing economy here in the U.S. Way too early to say that it's been improved, especially since 1 month does not a trend make. But basically, we're hearing good things on the labor front. We're hearing good. We saw some good news on the manufacturing front. Inflation is not as cooperative as we might like it. But again, this points to a stronger general economy and does not require the immediate intervention of a central bank, to right the ship.
Steve, who knows what the next week holds? We'll get across that when we speak next. Thanks for joining us from Interactive Brokers.
Sounds great. See you then, Andrew. Take care.
Let's now focus locally. How we're likely to open. Of course, we saw those very heavy falls yesterday. The market staging somewhat of a comeback this morning. At least that's what SPI futures are indicating, which are up almost 0.5%. Stay with us because the open is just a couple of minutes away.